Well, this is urgent, people. Welcome to the bear market of 2025. The Qs, Nasdaq 100, is officially in that red shaded area, which is Wall Street's definition of a bear market. Although there was some signs early on that we could see some volatility, IWM is deeply into bear market territory, and the S&P 500 is still not off 20% of its highs. Now, there was definite signs that the market could turn around. In fact, in January, I started plotting videos out and warning people, not trying to create fear, but letting people know in these analogies how I saw these markets. And as the dates progressed and we moved forward towards February is when we really started to see some things that could take shape in these markets. A big burst of energy is coming was the words that I used. And in the video, we discussed just how tight these bands actually were. And one of the basic principles of technical analysis is that markets and assets, they move between periods of contraction and expansion. And when this line is way down here to an area that we haven't seen in quite some time, it lets us know that that big burst of energy is coming. In fact, that day was right over here, and boom, some might say that that was a wild burst of energy in the markets. And this last week was very, very powerful. In today's stock market brief show, we're going to dive into some charts that you may have not have seen before. I'm going to be going over some long-term bottom signaling charts that are kind of looking surprising right now, actually. And then also some shorter term signals, because as a bear market unfolds, which this is one as it stands right now, we don't know where the bottom is going to be. We only know in hindsight. That's just the reality of it, right? We got to look at shorter term pivots in these markets. We got to look at these expected moves, which I'll get into because it is insane what I'm seeing right now. Now, if you haven't done so already, make sure to hit that thumbs up. It'd be greatly appreciated. That is one way that you can show some support to this content that I put out. Big thanks to my partners, Interactive Brokers. If you haven't checked them out, just take a look at their website. There's a pinned comment down there. Look at their campus. They have a bunch of free resources, free tools. They have a beta desktop version, which kind of looks like Webull in a way, but it includes trading view in it. It's pretty cool stuff. They got webinars, all kinds of stuff. They have courses from beginner to advanced. And then a big thank you to all my patrons that have been there. They've been patrons since I started this program. It's only $9 a month. I give a whole host of benefits. If you're have questions about it, I do plan on putting out a video. Been rather busy on walking through all the various benefits here. One of the big ones, I included the entire TradyTix suite of Discord bots, including the query channel where you can type in all these different types of commands to get all types of cool data within that channel. You get access to the community and so much more. And if you don't want to pay $9 a month, I'm not much of a fan of paying monthly on things. I like to do the annually. And if you do sign up annually, you get a little bit of a discount. It ends up being $90. It's not an alert service, so don't think that it is. Let's get into today's show. All right, people, welcome back to the show. I want to start off with this chart because this is one of the few charts. So when I got interviewed over at the Nasdaq on December 18th during that closing bell, which we saw that volatility, I was talking about kind of the back-to-back years that we saw in the S&P 500 and compared it to other times in history that we've seen it, right? These last 2 years, not including this year, we saw over 20% gains in the S&P 500. From my perspective, when I'm out on Twitter, social media, and stuff like that, I'm seeing a lot of people come up and rise to influence given the context of how easy it was to make money. They can throw a call, they can buy this or buy that, and the chances of it going up were rather high. And now we're starting to see a big shift in the market. And these people typically evaporate during tough times because they don't know how to protect their capital. They might buy the dip and then rebuy the dip. And I want to just be very clear here that when you're in a bear market, if your strategy doesn't change and adapt to market conditions, unfortunately, you get left in the dust. So this game, it's all about protecting capital. That's my main focus, protecting your capital and then growing over the course of time. It's not about being right. It's not about being wrong. It's about doing what's right for you. Okay, so back-to-back years. This was 23 and 24. Now we're pulling back. The other time that we saw that was actually 98 and 97. We still went up a little bit higher, and then we started going through that dot-com bubble. Prior to that was also 95 and 96. So this was a massive, massive run up here going into the dot-com bubble. Now, prior to that, it was 1954 and 55, and then we had a down year. Prior to that was 35 and 36. These are a long time ago. And then we had a massive down year here, basically wiping out the prior year and almost the year after that. And then the only other time prior to that there was 1927, at least that I have data of 1927 to 1928. We went a little bit higher, and then we went into the Great Depression. Now, yesterday's trading day, last week's trading week was rather insane. These are not small moves by any means. Energy was down 9% on the trading session. Financials, an incredibly important sector to the economy, down 7.32%. Technology sector, another massive hit of 6.5%. Everything was there in the red, other than the volatility index being up 50.93%. In fact, if you look at volatility of VIX based off seasonality, hello, there it is, right? Typically in this time frame, you do get these spike ups, and then it starts to settle in. And well, if this is going to turn into something bigger or not, we don't know yet, but it is still really matching the seasonality script rather well. You can even see here SPX seasonality. This was a big sell-off to a new low. And we've been saying that, hey, the S&P 500 for based off seasonality typically does make a new low. And then we could start to see it start to find some sort of a bottom. Whether that's here or not, I don't know. But I do know what capitulation looks like. And capitulation typically looks and feels like this. Doesn't mean we can't go lower, but this is what you want to see in terms of capitulation. You want to see red across the darn screen. And these are not by any means small moves. Tesla was down 10%. Nvidia was down almost 8%. Apple was down almost 8%. Again, coming off a day that was 9% down the prior trading session. If you look at the advanced decline line for the S&P 100, 97 declining stocks versus 4 advancing. That right there is a correlated market, okay? That is what you see and what you want to see in capitulation. Now, during this entire sell-off this year from the highs, we have not seen a day close like this of this highly correlated in the S&P 100, and we finally just got there. So my thought process in all of this is that, simply put, I believe that we are pretty much seen the worst of the selling, not to mean that it can't go lower, and I'll talk about it a little bit more, but as far as the aggressiveness, and I have a plan to approach this if I am wrong. Now, if you look at market net flow throughout the day, which is one of the tools that you can bring up, it doesn't show convergence down here, but it'll show this right here. One of the tools that you can bring up if you are in the Discord, and it was red and green like this the entire day. So we had a bearish divergence through the entire trading session, and you saw pops higher, lower high, lower lows, and so forth down through the entire trading day. So it was a product of flow in the market. Now, when are times, this was a really cool chart posted by Subu Trade again that I want to share. When were the times that we've seen back-to-back consecutive days of 4.5% declines throughout history? And it's far and few between. We don't see this very frequently. So what happens after a day later or 2 days later or 1 week later and so forth down the road? And you'll notice you actually start to see a lot of green on the screen, which goes to that whole feeling of saying, hey, we could be within the realm of being fully capitulated, right? Once again, it doesn't mean that we can't obviously go lower. We close at the lows of the trading session. So I'll talk about what it is I'm specifically looking for if we go lower. So first and foremost, the most recent time was in March 12th of 2020. And the day later, the market was up 9.29%. Prior to that was the financial crisis. Multiple times throughout the financial crisis, that was 6% down, 2% up, 6% up. Time before that, I'm not going to keep reading all these off. 1987 crash. All right, so I was born in 1987. Some of you here may have lived through that, and some of you are far from that 1987. You're more in the 90s and so forth, okay? So more recently, this is the data that suggests, hey, we're near that bouncy period. But there are a few times right over here, and that happened to be during, well, the Great Depression in 1929 and then 1933, where we saw some serious sell-side activity there too as well. And if you look out further, a year later, you do see the market doesn't look all too bad overall. So is this statistics that you can trade off of? Not necessarily. You do want to still plan out trades. And if we do get continued sell side, once again, I'm going to show you exactly what it is that I'm going to be looking for if we get a full blown out day one more time. Now, S&P 500, there's some lines on my screen right here. The solid lines are the monthly expected moves. We blew through the monthly expected move, and we're down near the quarterly expected move, and it is the start of the quarter. Okay, so this is a very, very, very powerful move in a very short period of time. And we're outside of the monthly clearly. And then this red shaded area, this is By the way, if you're in the Discord, if you go to the stock market indicators channel and you look at monthly/quarterly expected moves, you can pull up these charts whenever you want. They're permalinked to it, okay? So you can see the updated. But this red shaded area represents the bear market. And that's just taking this high, timesing it by 0.8 and giving us a reading of down here, which is minus 20%, okay? That's what that is. Now the Qs are down there at the quarterly expected move, right on that level, and then also in that bear market territory. IWM saw the brunt of the selling, and it is down there at the quarterly implied move and well into the bear market territory. Now, what comes to me as interest going into this next week is just how much data we are going to get. And on top of that, we have earnings season around the corner with all the banks starting to report on Friday. Now, on Thursday, we get inflation data. We get FOMC minutes. On Wednesday, we get some more Fed speak. We get Michigan consumer sentiment. We get PPI. So we have a week full of data, a week now of earnings. So what is the market doing in terms of expectations? And let me just say this. This is the largest expected move all year, but it is the largest expected move I have seen since I've started recording this. I have about 5 years of data, and I was trying to go back and find something this size. I couldn't even really spot it during the pandemic. I'm going to have to probably look a little bit more closer at that, but this is the largest weekly expected move I've seen. And what I find so interesting right now about this is the data that we have for this year's expected move. So we're now 14 weeks into the trading year, 14 total weeks that we've closed out trading, okay? Now, 43% of these weeks in here, we've actually closed outside of the weekly expected move. So that's that blue shaded area there. We closed outside of it, which, by the way, that's actually kind of a high number, which tells me that the market has been not good at handicapping the risk that we've been seeing as of late. And this week, I saw some people, including a market wizard, say that this move was nothing. And I had to respond and say, no, this move was huge. This weekly expected move was near a 4 sigma move, which is not by any means, quote unquote, nothing. That is gigantic. Now, we've tagged the expected move. Out of these 14 weeks, we've tagged it 92% of the time, which means that that's every single week except for 1 week, which was this week right here. We've tagged the weekly expected move. And I say this because the market now is putting a range up here of almost $33, knowing darn well that we've tagged the expected move 92% of the time. So when I'm telling you, if what I think that the markets, I think that these type of moves are over and done with, I think the aggressiveness of this selling, that was the peak aggressiveness, which doesn't mean I want to be very clear when I say peak aggressiveness. I think I wrote that over here. We'll talk about this chart behind it, but we saw the 97 decliners in the S&P 100, which is exactly what you want to see during capitulation. I'm not calling for a bottom, but what I'm starting to think is we've been seeing peak aggressiveness. Now, in short, what did I mean? I just don't believe we're going to get another minus 6% down day in the SPY anytime soon. But I do think that 2 to 3% down days and up days are definitely still on the table with this volatility. Now, if I'm wrong about this, and we see another minus 6% day, that would take us to the lower expected move. And I know exactly what I'm going to do if we get down there. I would prefer it to happen and be an outsized Monday, right? Mondays, we've been seeing some very aggressive moves. So if we get follow through on this day, and we get an aggressive move down to the lower implied move, that right there, to me, I'm going to be buying the heck out of that. And I'm going to be doing it across various sectors, assets, whatever it may be. There's some stuff on my watch list and so forth, maybe just the ETFs themselves, but I'd be looking for a tradable bottom bounce. Not saying that, hey, we're going to all-time highs from this point, but an aggressive move for another minus 6%, where people will call that the Black Monday of 2025, right? I don't know what it's going to look like, but after an aggressive move like this, coming into a weekly implied move, if we actually do that, which I don't think is going to just like, I just think the probability of that happening is slim, but we'll see, right? So I'm not trying to be right or wrong, but I do have a plan just in case if that happens. So that's what I'll be looking for coming into this Monday. Now, I want to talk about face ripping rallies because a lot of people, I'd like to show this chart during face ripping rallies. This right here down here is a 1-day rate of change. And what it's basically showing, like it looks like a heartbeat basically, but notice how that the big moves up and the big move down, they're kind of surrounded by each other. Like you can kind of see it go skinny and then bigger on both sides. What is that telling you? It's telling you that this is, first off, 0%, right? 0. And then up here is the percent that the day was up, and this is the percent day that it was down. And what you'll notice here is the big down days are surrounded by big up days and vice versa, right? Big up days are surrounded by big down days, big down days, big up days, big up days, big down days. What does that mean? It means that when you're in the realms of volatility, when you're in bear markets, which I'm highlighting the ones where we were basically in bear markets, right? 1987, 2000, 2008, 2020, right? And you saw more pockets in between this. But what I'm calling out here is, first and foremost, a -6% down day we haven't seen since the pandemic. Prior to that, you have to go back to 2011, 2012, and guess what happened during then? The Fed stepped in and did what's called and what's known today as Operation Twist. And prior to that was the Great Financial Crisis. So these moves, they are rare. You don't see these moves, but when you do see these moves, they are surrounded by big up days. So the point here is be prepared to see that face ripping rally. They are coming, they are around the corner, and how it gets there, it's very hard to trade these things. It could happen overnight. It could happen during the day. It could be a catalyst that drives it. It could be order flow that drives it. You just need to be prepared in times of high volatility. And if you miss the move, just be aware that it can come right back down, okay? This is not an easy environment to trade. So what I tell people, if they are actively trading smaller positions, wider stops, and be tactical. Now, this is very cool here too. I took a 10-day rate of change, which is 2 trading weeks. And this is the SPY here. And what I'm pulling out here is you can see in 10 trading days, we went down over -10%. The last time we saw that was actually the 2022 bottom right there in October. And then the time prior to that was this bottom after a big sell-off, and we ripped up higher and we put in a new low. Prior to that was the pandemic, which we actually went significantly lower than 10%. Prior to that was the 2018 going into 2019, known as the Christmas Eve massacre, right? And that found a bottom there, a tradable bottom. And then over here in 2015 in July, we saw market massive volatility. This is during, I can't remember exactly what this was. This was some global scares down there. I think it was around some global scares. I can't recall. I'd have to look it up again. But a -10% down week, a very extravagant move, and then we found a tradable bottom, okay? Another interesting thing to look at is the extension that we see from like a 200 period moving average, right? So the 200 EMA. So on this chart, you'll see the Nasdaq 100, I'm showing the Nasdaq 100 with the 200 EMA on it. And this line right here is representing how far we are below it and or how far above we are above it. And you'll notice the last time we bent down in this area was 2022, trying to find some sort of a bottom. And the reason I'm showing this is because when you get these multiple standard deviation moves from one of these key average trading prices, it's common to see snapbacks and it's common to see breaks below them further. But what I'm just pointing out here is, hey, -12% over here. When we got down in this range over here, other than the bear market, right over here in 2020, that was kind of where we were during the pandemic as far as extended from it. Why wasn't it more? Well, because we actually extended further from it to the upside before coming back down. And then right here is about the same. And then prior to that, financial crisis. And then earlier in 2008, before the main, this was prior to the peak, but we saw a big rip your face off rally before we went into the financial crisis there. Now, I want to show you even something more interesting from this perspective as well, and that's looking at the deviation from the 5-period weekly moving average. And I want to show you just how rare it is to get this extended. So this is the S&P 500 weekly chart here, and this right here is the PPO, the percent price oscillator, but I have it adjusted to show you how far it extended from that weekly 5 EMA we are. And right now we're about almost 8% extended to the downside. And you might be thinking, well, it's only 8% from that. Well, this is one of the more frequently tagged EMAs. And look at the last times that we've seen this. This is 50 years. This is dating back to 1976. Yeah, you heard me correct. 1976. When are times that we've gotten this extended from it? One, two, three, maybe four right in here because I can see a little line right there. Five, six, seven. 7 times. 7 times in 50 years that we've been this extended. 7 times in 50 years. How can somebody sit here and say the move that we saw last week was nothing? That's the most dumbest thing I've ever heard. So the reason why I'm showing this too, simply put, is because these can lead to potential bounces in the near term. As you can see, you just look up and these were massive kind of fades, capitulations before bouncing higher. However, just be aware that just because you bounce, it doesn't mean that it's the bottom overall. This over here was the 1987 crash, and we did find some sort of a bottom right around there. But during the dot-com bubble and then during the great financial crisis, we continued to put waves lower and lower there. Now that's the SPX. What about the Nasdaq 100? The Nasdaq 100, same thing. We're at 9% from the weekly 5 EMA. Last time that happened was the pandemic. Prior to that was the great financial crisis. And you can see sometimes during the dot-com bubble, and then also here in the 90s where we had a recession, and then also the 87 crash. Very, very rare stuff taking place. Nasdaq Composite, this is down 9.3% the last time we saw that. The pandemic, prior to that, the financial crisis, and you get the point. Now, if you look at something like Bollinger Bands, I mean, this is pretty rare for the most part, right? You've left the Bollinger Bands completely. This is the S&P 500 on the daily time frame. We saw a minus almost 6% down day. We opened and we opened at the high and we closed at the low, which is not a great sign, but that is a sign we start to see some sort of capitulation here. Now, when's the last time that I kind of see right on my screen that this happened? Not too long ago, but that was in August. In August, surprisingly enough, right? This was, so basically, okay, so I got this confused on a prior video, but in July, right? That's when the new quarter started. And then when July ended, right? We basically we were unchanged on the quarter. We basically opened here, we closed here. So we had a wide open quarterly expected move. And this day, right here in August, in 3-4 short trading days, we tagged the quarterly expected move and found some sort of a bottom. The reason why I'm saying that now is because in 3 quick trading days in the new quarter, we're right there already below the quarterly expected move, as I previously just showed here at about 5,100 on the SPX. So these are some violent moves. And it's fair to say that we can see some rip your face off rallies in the very near future, but just be aware, it's not going to be easy to trade them. And chances are a lot of people will miss them, especially if it happens over this weekend, right? Or if it happens overnight and you're not prepared. And the way that you prepare, one more time, small positions, wider stops, because that's, if you go too heavy, too hard, and you're wrong, you can get burned and you yourself can capitulate. Another way to find shorter term bottoms, I like to look at the percent of stocks above the 20-day moving average. And you can see that now we are getting some very frothy down signals here where you're noticing that they are in these technical oversold conditions. What is this? What does these numbers mean? Well, down here's the S&P 500. We have small caps, mid caps, 1500, S&P 100, Dow Jones, Nasdaq, NYSE, and Nasdaq. And what it shows us here, which I know it's hard to read, but that's fine. We're going to look at the S&P 500. It says 6.4. What does 6.4 actually mean? Well, it's telling us that 6.4% of stocks in the S&P 500 are above their 20-day moving average. 6%. Let's make it a little easier and look at the S&P 100. It says 3. What does that mean? It means that 3% of the stocks in the S&P 100, let's do the math there. It's very hard math, okay? What's 3% of 100? It's 3. 3 stocks in this entire S&P 100 are above their 20-day moving average. That's just telling you that people are puking. Now, the 20-day moving average is a short-term moving average, as we've already previously discussed, okay? So this is where you can find potentially shorter-term capitulations. Now, if you look at stuff like the 50-day moving average, now we're starting to cook. We haven't seen these levels, for example, here since 2023 in the S&P 500. Here, you'd have to go back even further. This is the small caps, very extended reading. Let's keep going here. Yeah, you can see over here back to October. This one's even deeper. This is the Dow Jones. You'd have to go back pretty far. I don't have it on my screen. Over here, the Nasdaq, percent of stocks above the 50-day. You'd have to go back pretty far here too as well. Maybe towards the pandemic area. And then over here, right, this is just showing us a couple of years of data. And if you look at the Nasdaq percent of stocks above their 50-day, only 10% of stocks. So these are some significant readings that we actually have not seen for quite some time. Now let's talk more about some shorter term signals that can give us insight to when we can see bounces. And I wanted to pull up this chart. This is the bullish percent chart for the technology sector. And we just got a reading down here at 7%. What is the 7.04? What does that mean? It means 7% of the stocks are on buy signals in the technology sector based off of tic-tac-toe charts. I'll call them tic-tac-toe charts, but they're point and figure charts. Now that's a pretty frothy signal, right? To the downside. Well, let's date back to the 90s. How many times has this actually happened? 1, 2, 3, 4, 5, maybe 6, 7 right here. So this is our 8th time in the last 25 years. That's pretty rare, right? So what has happened when we got down into these areas? We saw some short-term signals that we could bounce and get your face-ripping rally. So we got our face-ripping rally here, and then it faded, made a new low, right? It doesn't mean that it's a all the way bottom or it's going to be the bottom or whatever the case is, okay? But sometimes when you get this frothy, this extended, this is near the time where you can get that rally, and then it makes everyone super happy and then thinks that everyone's like, it's back to normal. We're back, baby. And then it rolls back over. And the flip side of that, if it is the bottom, there's also a lot of people that don't believe that it can be the bottom. And what happens then? It ends up being the bottom. And then they look back and they're like, and then they still try to make excuses as to why it should still roll over. And we have ways to approach that, mainly market conditions, the two things that I look at, which we'll continue to talk about on this show. And if you haven't done so already, subscribe to the channel. It's free to do so. Okay, it takes me a long time to put out this content, and it's all free, other than the Patreon community that supports me doing this for $9 a month. Okay, so what can we potentially see here? Well, potentially more sell side, but if the reading gets any more frothier, I mean, this could be a sector to watch out for those bounces. As we've seen, these tech stocks get absolutely annihilated. If you look at if you zoom into this chart, this technology sector bullish percent chart, it's down here, right? So we're zooming in. I just wanted to call out. There's also that bullish divergence on the RSI as well, which is, that's a positive sign for me to start looking at these names for a potential bounce. So you can look at the Nasdaq 100 bullish percent chart too. Pretty frothy reading. The reason why is because they go hand in hand here with also that positive divergence. Now this gets interesting. The Nasdaq McClellan oscillator up here, I kind of highlighted some areas of kind of known to be oversold conditions and then overbought conditions. And I got the Nasdaq composite down here, and you could just kind of highlight times like, oh, got over here oversold and we found a bounce. Got over here oversold, we saw a bounce, and then it faded to go lower. Over here, boom, we found a bounce right over here. I don't even know. Yeah, right. So it was right this little area. We went down lower and we saw a little bit of a bounce. Over here, we saw this little spike down, saw a little bit of bounce. So you get my point. So we're moving into the oversold condition here. After a day like yesterday, I am shocked that this thing isn't a deeper reading, which that kind of throws me a little bit. And that's why I'm so interested in these bigger term bottom charts, is because they're actually not extended by any means. And that to me tells me one of two things. They're not going to work, or we got longer to go to the downside. So as far as market conditions go, we remain under the gamma flip line, which is roughly at about 57.50, which is well deeply negative here, which means what? It means that we can get selling into selling, which we've been getting, and we can get buying into buying, which we have not really seen yet, other than a few times and few pockets of that. That is what negative gamma does. When you're in negative gamma, liquidity dries up, volatility increases. We just went up 50% the other day, so clearly you're seeing that. The next thing I look for as far as market conditions go is the direction of these 5-day moving averages from a very shorter term perspective, okay? And what is it telling us now? Once again, this has been how many days? 34, 35 trading days deeply into negative gamma territory. This is where day traders typically do better if they know what they're doing in volatile times. They have the strategy to do that, but it's where swing traders really suffer, right? They can do good if they're from the short perspective, but swing traders typically, like for example, breakout traders, they get a lot more fake outs, a lot more shakeouts, a lot more whipsaws, then they complain more. And it's because they don't have a process in place to understand what to do when conditions of the market are not proper for whatever strategy that they excel in. You need to adapt. That's the only way to do that here, is to know and have a system and a strategy around what you determine as far as market conditions go. So for me, as a breakout trader, primarily swing trader, these have not been conditions for the last 30 plus days. So if you're in the Discord and you're like, why aren't you posting more trade ideas? Because of this. And it will change, and I will post some stuff, but as it stands right now, it just hasn't been the environment for it, unfortunately. All right. And you could see here, this is the last time we were seeing this kind of negative gamma, which by the way, this is a little bit oversold condition. The last time we were down here was right here, and it did kind of resolve in a little bit lower, but we did end up seeing a little bit of a bounce here. It looks little, but it was a pretty nice bounce in the S&P 500. You can see here that CTAs continue to be massively short and selling into this selling. And you can see that vol control funds are also a big component to this sell side activity that we're seeing. You can see the VIX futures curve still deeply into backwardation. For those that don't know what this is, that's fine. It's totally fine. But when this line starts up here, this is the May contract, the June, the July, August, September, October, November, December. You don't need to look at all of those, but that's what I'm looking at. And this right here on this axis is showing you the VIX, where the contract is priced. And in short, what does this tell you? It tells us that, hey, we got a high VIX here and now, and we see less into the future. And the way that you read this is simply put, we got problems now, right? What you want is this to go like that, because it's always saying, hey, yeah, we'll see problems in the future. Yeah, that's normal, right? But right now, we got problems here in the present. Back month versus front month volatility, this thing continues to sink off probably to levels that we haven't seen since the pandemic. This is very, very frothy reading over here. By the way, when we're under 1, this is where you start to think that we can get the base out and some sort of a bottom. We've been saying that for the last day or 2 over into this territory, and the sell side keeps continuing to go here, and now we're just continuing to get this frothy activity. So this just leads me to believe that we're getting a stack on stack of these shorter term oversold conditions, which means that the stronger that these oversold conditions get, the more violent a bounce can be. And we don't know if that's going to necessarily be the bottom, but it could definitely be a trap. And well, that's what we got to be very careful of. Now, if we talk about expected moves, I showed you specifically the SPY on the weekly time frame. I want to give you this going into tomorrow's trading session. These are daily expected moves. I'll share with you the weekly for the S&P 500 if you want these. Once again, this is something that I share to my daily on the Discord group. I don't have the ES levels yet because I'm going to be pulling those at 3 p.m. Pacific Standard Time on Sunday, just slightly after when the futures market opens up, to give me a clearer picture. But these are gigantic numbers. S&P 500 expected move just for tomorrow is $208. That is plus or minus. I have the upper and lower levels labeled out over here. This is by no means something to joke about. This is a gigantic expectations of risk going into tomorrow. So please be aware of just how powerful this is. If I can't go back in time and show you really when we've seen a move like this. I haven't seen an expected move this large from this short of a period of time. I don't even remember this during the pandemic being this large. So these are wild, wild, wild expectations of risk. So maybe the market finally is pricing in the correct risk here after the bloodbath that we've already seen. Here's SPY on the 15-minute time frame, right? This was the tariff announcement, closing bell, right? Where we announced after the bell. And that VWAP I find to be important. Why? Because the average buyer basically from that announcement has been underwater, and you can see we bounced up to it and it rejected. So you might even be able to actually anchor a VWAP to this specific level as a hands off, but just know that this is in confluence with the upper daily implied move for tomorrow. Our upper weekly implied move is at about 538. Even if we were to get there tomorrow, where would that put us? We'd still be below last week's week-to-date VWAP. We'd be below right around the month-to-date VWAP for April, and we'd be below a declining 5-day moving average. So a rip from 505 to 530 or higher right there, that would bring in all kinds of excitement, okay? It would. But just be aware that that also could be your face rip and rally and a lower high, right? That's a reality. Now, if we get some massive sell side tomorrow to start the day, massive panic, Black Monday, blah, 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 okay? I'm looking for a very aggressive move down to 472. I don't think that we're going to get a -6% down day tomorrow. I really don't. So, but I need a plan just in case if we do, right? I need a plan, right? So I'm not thinking that's going to happen, but if it does happen, right? On the last video, we talked about going down to the quarter to date expected move. I was like, I don't think that's going to happen, but this is where we can go. And we got there. All right. So once again, I don't care about being right or wrong. I'm making a plan for if things go crazy. So right at around this 484, which is a super huge move too, I'm going to be looking at net flow, see what happens down there. If we get down there, maybe I'll look to try to trade a tradable shorter term bottom down here. But I'd ultimately want a very aggressive move down here. And from that point, I would try to find some sort of a tradable bottom. Until then, I'm going to be very, very meticulous on what I'm doing from an intraday perspective. So the path right now for most people is to stand aside and or take small fires in out of positions, but make sure that they are smaller positions, right? Pick up some change if you can, but smaller positions, wider stops. Be patient and build into positions. If you're looking for bigger opportunities for investments, look for things that big names that aren't going anywhere, right? And then do your research that way and then slowly build in. There's no rush here. You don't want to get into a big investment and then or big trade and then turn it into investment because it keeps going down and then you try to average in lower and then capitulate at the end. You want to be patient, okay? That's the main key element to all of this. I want to look at some intermarket charts now, just various commodities and so forth, because there's a lot of crazy moves happening from an intermarket standpoint. So first and foremost, copper. This is, we talked about copper on the prior episode. Copper was down 8.83%. I should have brought a rate of change chart here and looked to see the last time we've seen a move like this, because my guess is it's not during good economic times. And during this run up here, what was everyone saying? Well, we're not going to a recession. Why would we go into a recession? Copper has a PhD in economics and it's going straight up. And we were basically saying, well, copper has a very tight correlation to China and China's been doing really well. Well, what is copper doing now? Copper is down 8.83%, which is a massive down day. And if this has a PhD in economics, over here on the run up, well, it still has a PhD in economics on its way down. In fact, we were looking at gold during this and we're like, it keeps going up. And gold is typically more of a safe haven asset. So what we did was we said, okay, yeah, copper was going up, right? Which people didn't think a recession, but also gold was. And gold was actually going up at a faster rate of change than copper, which was driving this line down. This is the copper to gold ratio dating back to the 70s. And what do you notice here? You'll see some gray shaded boxes, and these gray shaded boxes are recessions. I'm showing the last 5 or 6 recessions over here. And what do you notice? When copper underperforms gold, right, the line goes down. It means gold's doing better. And what do you notice? During moves to the downside, not all moves to the downside, but these recessions, typically you see sharp moves to the downside in this relative strength ratio. What happens? Well, you typically can get recessions. And what do we see happening right now? We're seeing a move pretty much straight down to lows that we haven't seen since around the pandemic. Does that guarantee a recession? No, but it's just telling us that there's been more of a push to safety than there is to more economic metal. If we take a look at silver, another big move down in silver, minus 6.74%. I knew this couldn't hold much longer. There's miners down there. We talked about how tight this correlation was from a one-for-one perspective. And you can see silver was down this day. Miners held up. And I was like, that's probably the most easiest short to call out. And sure enough, the next day, not only do we gap down, but we close at the lows too. That's a massive down day in the miners there. Crude oil took it on the chin again, minus 7.41%. Simply put, these aren't small moves by any means. This is going to spark growth concerns. If you zoom out and look at a larger picture here, you can see that we've tagged this level multiple times and we finally had a break. Can it reverse and go back up and whatever happens? Well, yeah, maybe. But right now, that's a pretty substantial break as it stands and a pretty big down week. And when you get a big down week, that's pretty common to see snapbacks. That's totally fine. But just know that that was a large break. I do find it interesting over here. Over here, if you go back to probably around the videos that we posted in and around this time, we made a video showing that, hey, this big rise in oil typically leads to bad things happening. And that actually led into the bear market of 2022. But if you go back even further, rapid rates of change in oil has preceded all the recessions that we've seen dating back to the oil embargo. So rapid rate of change in oils is not necessarily a good thing to the upside. And then also it could spark growth concerns to the downside from a rapid rate. But what we did here, which I'm just telling you because I thought it was so cool, is we drew this megaphone pattern out, but this is actually not something that your average person put together. This is Jesse Livermore's speculative chart, the accumulation cylinder. And during this time, we mapped it all out and we're like, wow, actually, this looks like we're reaching that period where we can see the top in oil for quite some time. And sure enough, even old technical analysis like this from a legend himself did play out. So if you want, go back to this video because I walked through this old book here and his stuff. It was just fascinating to me when I was bringing this chart back up. 10-year yield, down day 2 as well, but we closed well off of the lows over here. When you get moves like this, common to see some sort of snapbacks, totally fine. But the yield, these are big, big moves in the 10-year yield. And it's important to note that we're talking about snapback rallies. And the reason why I'm saying that is because when you get a strong move like this, and if you bounce back, well, how is it correlated to the S&P 500 right now? When you can see a 20-day correlation is very, very positive. We're at 0.82, which means what? If the 10-year yield bounces, it's probably pretty common to see the S&P 500 move forward with it, and the Nasdaq and then the Russell 2000 as well has some pretty strong correlations, including even right now, the housing market too has a positive, housing index has a positive correlation. Actually, across the board here, including China, they have positive correlations in this moment right now with the 10-year yield. The dollar had a big inside day, bouncing from its lows as well, closing near the highs. Very common, right? After you see a fall like this, it's very common to see snap. It doesn't mean that the bottom's in by any means, but you can see here, we had this trend line built. We broke above it, had this little head and shoulders. We broke through it, back tested this confluence, and we broke down. So if we do something like this, maybe that sets something to go higher. But right now, this 104.5 would be the level of contention for the dollar. Now, what happens as far as the dollar wants to continue to bounce? What would that do to various assets? Well, right now, there's not much of a strong correlation across the board, but they are positive. So you do have a positive correlation with the dollar and the S&P 500, the Nasdaq, and the IWM. So even a rising dollar right now might be okay to see in the short term with a market bounce as well. Excuse me. The next thing I want to look at here is the sailor to shift tool. And the sailor to shift tool was starting to turn positive and still is. And this is the rate of change, the 4-week rate of change between Bitcoin and gold. This is something that I put together years ago that many people, including various YouTubers, still use to this day because it's such a powerful signal to look to when to get in and out of Bitcoin. And you could see we've caught big run-ups and we've saved ourselves from big sell-offs, including most recently right in here where we had a sell signal and a trigger. I made a video separate of this one, the sailor to shift tool. In my YouTube, you can just do figuring out money, sailor to shift tool, sailor like Michael Saylor and shift, right? Or Bitcoin indicator, whatever you want to Google there, you'll find it. And I walk you through the specific strategy that I use. But you can see we've been down ever since, right? We saw some bounces here and there, and then we saw our flush. So we are still on an active sell signal, sell trigger, and we have yet to actually have a weekly close above it. So maybe next week we'll get that close above and I'll continue to show you what this chart looks like over time. Now, I want to talk about these longer term bottom signals, right? And then we're going to get into the big picture updates too as well. There's a lot of stuff here, people. This was a 75-page deck that I put together over the weekend, right? So some of the longer term bottom signals seem to be helpful for finding bigger picture bottoms. Now, this one isn't, I still put in one of them, but it's not as powerful as some of the others. And this is the Nasdaq Cohen high-low index, and it's on the weekly time frame. And I'm just pointing out this 0.05 level down here. I'm not going to walk too much into the intricacies of what this is, but I'm going to show you if you want to pull this up yourself on stockcharts.com or if your platform has it. Cool. Weekly time frame, 0.05 reading. That is a very, very frothy reading to the downside. In fact, if you go back, we got down there at the 2022, near the 2022 bottom, but also during this process where we saw bounces in 2022, it did get there multiple times in weekly closes, and we saw bounces from those areas too, which caused a face rip and rally, and it sold back off, okay? Over here, we didn't quite get one, but that happened to be near the correction territory of 2023. And if we continue down the screen, you can see the pandemic, boom, tagged the low. Over here, the Christmas Eve massacre, boom, tagged the low. Over here in 2016, where we saw kind of all kinds of crazy stuff going on, didn't tag the low perfectly. We saw face ripping rally, new low, found a bottom. And then even in the great financial crisis, we tagged it multiple times, catching some of the shorter term bounces and then the bottom overall down here. Now, why do I find this so interesting? Is because look at, after this week of selling, this reading, that ain't nothing. We can't do anything with that, which tells me what? Tells me that, hey, if this is going to go into a bear market, this is not by any means oversold in any condition. So I find that to be very, quite frankly, quite interesting. The next one is the Pring bottom fisher. I love this one. This one is just, this one we talked about, go back to 2022 bottom. We talked about it there. You can go back to the pandemic. You can go back prior, right? This is a very powerful tool for finding bottoms. Some people all of a sudden want to try to use it to find tops and do this and do that. Look, at the best way to use this from what I've found out and from what I read about by Martin Pring himself, the creator of the Pring bottom fisher, is that when you get an extended reading down here at -30, both signals, the 10-period moving average of it and the other one, and then you get a cross back above. That is the signal that we can find a longer term bottom. And I have it, you can go back further, but I'm just showing you here because it's a little bit cleaner. Both bottoms over here, or near those bottoms, over here coming out of the massacre, over here in the pandemic, and then once again the 2022 bottom. Now, why do I find this interesting? After the selling that we've been seeing, not only for the year, but more recently too. What the hell is this reading over here? This ain't oversold by any means. So I guess we can't use this either right now. So for if any reason we start to get this more further down here, I'll be bringing it back up again, but it's not there yet, but it has been helpful in the past. This is more recent that I've shared, and this is looking at some very, very important stuff from more of a sentiment standpoint, and that's the put to call ratio up here with the 10-period moving average, and then you got skew, which just gives you an idea of hedging activity, I guess we can say. And then we have the S&P 500 down here. Now, I'm calling this out because when you get very frothy movements to the downside, there is something very specific that happens at these levels. You get spikes into and around 1.2, not always up there, but let's just say these times over here, 1.2, maybe even down here, right? I'm not even going to use this one. We'll just use 1.2. Well, how about that? Because this can be the very specific indicator or tool that we can use to see when the hedgers get flushed out, when things are too bearish, and then we can potentially look for these bottoms. And if you get up into these ranges up here, right, take a look what skew is doing those same times. Skew flushes down to and around 115. So up here, it got down to and around that 115. Down here, got to and around that 115 level, while the put to call ratio was higher. And what did that do? It marked the bottom over here, coming out of the bottom, that higher low, and also the pandemic low right here. Now, why is this interesting to me? Is because we're still at a 140 reading on skew. And now during this time, what I find so interesting is this was the highest prints on skew that we've seen forever, right? And this was when the market was going up. And it's like, okay, so did they know something that was going on here? There's just massive hedging activity taking place. And then boom, it comes to light. Well, it's still high. And we didn't really get a flush out here, but you'd want to see it down more in these regions. And while that's happening, if that happens, you'd want to see this back above 1.0 to potentially start turning back around, right? We might not get to 1.2, but we might find tradable bottoms or bigger bottoms, once again, when we get more data on these various assets here. Okay. Another longer term bottoming type signal is when you look at the percent of stocks above like something as big as the 200-day moving average. Now, this tool can find tops and bottoms. Now, when it finds tops are a process, and they could take over a year of price action diverging. So that's all that's highlighted on my screen, right? You can see over here, we peaked out here, and then the percent of stocks above the 200-day kept on dropping and dropping and dropping and dropping and dropping and dropping and dropping while the market went up, 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 and boom, we went into a bear market. You can see that here. Market was going higher and higher and higher. Percent of stocks above their 200-day. No, we had some internals weakening, to say the least, and bam, we slapped down. Now, what would be the bigger bottom signal? I would be looking for positive divergences. So first and foremost, we're getting down to and around 15%. That means only 15% of the stocks are above their 200-day moving average in the Nasdaq composite. The Nasdaq composite is a composite of what, 3,500 stocks? I don't have the exact number in front of me, but about 3,000 plus stocks in the Nasdaq composite, and only 15% of them or 16% of them are above their 200-day. That's very weak, and it's typically when you get these extended areas, you can see snapbacks, which we've seen in the before. But if it's a long duration bear market, notice how we put in a new low here, but yet the internals were actually strengthening, where we had more stocks above their 200-day moving average, and it led us out of the 2022 bear market. So those are the longer term signals that we want to pay attention to, that I'm going to be paying attention to, that I'll continue to share here. Now let's look at some of the bigger picture charts. Just once again, to give you some updates, the last few videos I've been sharing the bigger picture charts. So I'm giving you a bigger picture update. First one I like to look at is the monthly time frame of the S&P 500. And we look at their yield curve, the 10-year 3-month, which by the way, it's still deeply inverted. Not deeply, it's 25 basis points, but it is still inverted. And then you can see the federal funds rate down here, and you see when they start cutting rates and the yield curve starts to uninvert, we hit new highs in the market, and then we went into a crisis of sorts. Dot-com bubble busting, financial crisis. We had the pandemic. Okay, those were the crises at that time. Now, what are we going on through right now? Well, the market is trying to price in more rate cuts. Actually, in fact, it's trying to price in 4 rate cuts, and we'll see if the Fed wants to come out and do an emergency cut, or if they're not going to do any cuts at all. We have no idea yet. We'll see as the data comes out, especially this inflation data that we're going to be getting. So if the Fed, right, starts cutting rates, what has happened in the past? Well, we start to uninvert, and what we've noticed in the past, it hasn't been good. Does that mean the same thing is going to happen? I don't know. I mean, it feels like it's happening right now. We don't know how deep it's going to be, but what we do know is that these times we saw 50% decline. This time was 35%. What would a 50% decline look like from its highs? It would take us to and around this area right around here, which would be roughly the 200 period monthly moving average, slightly higher than that, and around the pandemic high. Now, am I calling for that to happen? No, but right, like if it does, I'm going to let it do it. I'm not going to fight it. I'm going to be trading tactically and watching my shorter term market conditions for opportunities to potentially find the real bottom. And if it's not the real bottom, what do? Well, we protect our capital. Okay, so that's one of them. The KBW Bank Index, another one that we've been talking about, and we put the federal funds rate down here. We put the federal funds rate down here. We put the 10-year 3-month yield curve down here. We just talked about the times that when it comes up into this red zone, why is it that there's always some sort of problem? I have no idea, and this will probably not last forever, but for some reason I wanted to bring it back up, and for some reason we're going through trade war 2.0 right now, and we're seeing the same problems, very similar to this 2018 type of move that we've seen. And remember, we capitulated and then we started finding some sort of a bottom. So hopefully that's going to be the same situation here, right? Things have moved far, far, far and fast, and there's a lot of stocks that are well off 60% off their highs that are big names. And yeah, we'll see where this goes. I like to look at the IWM. We were talking about a spike in volatility to happen for the Fed to slam the brakes on these rates and start to really press the gas down on cutting. Well, you can see here, that's what's happened in the past. Small caps do really well in a zero rate environment. Why? I mean, money's cheap. People spend when money's cheap. And if you think about people spending money, I mean, you think Russell 2000, right, which resembles the economy for the most part, one of the better ways to resemble the economy, right? The smaller companies. I guess that's one way you can look at it. Even rates down here were smashed to zero and we rallied up. So if the Fed starts cutting at a rapid rate or going back down to zero for whatever reason, well, you might want to look at small cap stocks, okay, which have been selling off, and we're not too far off from this lower trend line. It is a logarithmic chart, so we'll see if it comes down into this range. But I did find it interesting that when we had a volatility event, that's when we started slamming these rates. But you can see it happened over here too as well. They didn't slam rates. It was these bigger moves of volatility in the RVX, that is. Okay, I'll continue on and look at the IWM on the monthly time frame. We talked about this larger term channel, bearish divergences, bearish crossover, bearish divergence, and a potential pullback to the lower portion of this channel, which once again is about 160, 150, depending on where it would be. You can see we acted as resistance here, and then acted as support. So we'll see if it wants to get down there. I don't know if it's going to get down there or not. Right now, we're already at the quarterly expected move, and we've seen 3 straight months of sell side so far. It's still early in this month, so who knows? But it's been rather strong. And if we continue to sell off into this green zone at about 165, 170, that's not only in confluence with prior support, prior resistance, but it's also at that lower monthly Bollinger Band there too as well. And then the last big picture chart that we've been sharing is the Dow Jones Global Index. And when we get up into these upper areas, right, of the channel, we've been rejected. And then when it comes to the lower range of these channels, we had the Fed, or we had some sort of policy shift of some sort, or some sort of economic event that changed the trajectory of these moves. So you can see Operation Twist. We had global growth scare. We had massive inflation print there on that marked the bottom there in 2022. This was the pandemic. This was the Christmas Eve crash over here, not quite reaching down to it. And then 2015 to 2016 was that global growth scare. And as you can see, we've been talking about it when it was up here, and that was a pretty large monthly move, down 7% so far. If 6 days into this month, we are heading towards the middle of that channel. We went over a lot of charts today. We gave big picture stuff. We gave you an intermarket perspective. I gave you specifics on what it is that I'm looking for as far as levels. If the sell side continues, if you have questions, I'll try to answer them in the comments. This is a time to be cautious. It's a time to be careful. It's a time to protect your capital. It's a time to enjoy missing out on trades, right? Another trader said JOMO, right? Joy of missing out. John Carter says JOMO, the joy of missing out. You do not want to feel FOMO, the fear of missing out, because in these markets, right, you got to fade your emotions to an extent, because what's going to happen is it's going to try to trick the most amount of people as it can in the shortest periods of time. I hope this video helps you out, and I'll see you on my next live stream, hopefully tomorrow, April 7th, 2025.